They say the market is a casino. That's wrong. The market doesn't know your name, your hopes, or your credit card limit. It doesn't cheer when you win or cry when you lose. It just sits there matching buyers and sellers like a giant vending machine for stocks. You, on the other hand, act like you're in Vegas. You watch tickers flash like slot machines. You bet on rumors, headlines, hunches. You double down after losses. And when you win, you tell everyone it was skill. That's not investing. That's blackjack with a briefcase. I've seen this movie before. When I was running the Magellan Fund, people would corner me at airports, cocktail parties, grocery stores. Peter, what's the next hot stock? They didn't want to own a business. They wanted to own a miracle. One guy told me he bought oil stocks because they couldn't go any lower. That's like marrying someone because they can't get any worse. They can, and so can oil prices. The truth is, the market's not random, but investors are. They treat every uptick like divine confirmation and every downtick like betrayal. They talk about playing the market as if it's a game, but you don't play ownership in companies that employ tens of thousands of people and move billions of dollars. You study them, you live with them, you own them. In the 1970s, I watched people pour money into Nifty 50 stocks, IBM, Polaroid, Xerox, because they thought blue chips could never fall. They didn't care what they were paying, just that the companies had fancy names. Then the market corrected. Those same can't lose, stocks dropped 60%. When I asked investors what they plan to do, they said, wait till it comes back. That's investor code for, I don't know what I own, but I'd like it to go up again. Let me tell you something that sounds cynical, but it's just arithmetic. Stocks don't know you own them. If you buy Polaroid at 100, it doesn't feel obligated to return there so you can break even. If it drops to 50, it might go to 20. If it goes to 200, it's not because it owes you, it's because the business grew. That's what people forget. The market is not a casino. The market is a reflection of human behavior, and most of it is impatience disguised as intelligence. People ask me, Peter, how do you stay calm when the market crashes? I don't. I just remind myself that businesses don't crash as fast as prices do. When Taco Bell fell to $7, the restaurants were still open. People were still buying tacos, but investors were selling like the company had started poisoning them. That's the difference between a gambler and an investor. A gambler reacts to odds. An investor reacts to facts. Every few years, some new wave of gamblers shows up. They rename the casino. In 1999, it was dot-coms. In 2008, it was real estate. In 2021, it was meme stocks. Same story. New costumes. They all start with, this time it's different. They all end with, how did this happen? If you treat the market like a slot machine, it'll treat you like a slot machine player. You'll get some hits, sure. But the longer you play, the more you lose. The house always wins, and in this case, you are the house's worst customer. Because the house doesn't have to trick you. You do it yourself. You panic when prices drop. You chase when they rise. You buy stories, not earnings. You sell facts, not fiction. You want to know who the market really rewards? The boring people. The ones who read footnotes instead of headlines. The ones who buy companies they understand, then go play with their kids instead of watching CNBC. The ones who treat investing like gardening, not gambling, watering, pruning, waiting. The market punishes excitement and rewards patience. That's been true since the Dutch traded tulips. So the next time someone tells you the market is a casino, correct them. The market doesn't deal cards. It deals truth. If you show up with a gambler's mindset, you'll get a gambler's result. But if you treat it like a business one you're willing to own through thick and thin, you'll find the odds shift in your favor. Because over time, patience compounds faster than luck. The market's not a casino. But if you act like a gambler, it's happy to prove you right. See? The funny thing about gamblers is they think they're in control. They pull a lever, the lights flash, and they swear the machine almost paid out. Investors do the same thing. They buy a stock, it goes up, and suddenly they're geniuses. It goes down, and suddenly the market's irrational. That's not control. That's ego wearing a necktie. I once met a man who owned 6 different mutual funds, all from the same company. He told me he was diversified. I asked him what those funds owned. He said, good companies. That's like saying you're on a healthy diet because you ordered 6 hamburgers. He wasn't diversified. He was duplicated, and he didn't know the difference. People crave the illusion of control in the market because uncertainty feels unbearable. They watch prices move every minute, thinking they can outsmart volatility. They trade more, check quotes more, worry more, and somehow feel safer. But here's the paradox. The more control you try to have, the less you actually get. Because every time you react, You surrender control to emotion, fear, greed, envy. And those emotions have never beaten the S&P. When I managed the Magellan Fund, we didn't have fancy algorithms or real-time dashboards. We had payphones and company reports. Still, the temptation to do something was always there. When a stock fell 15%, analysts would panic. Should we sell? Should we hedge? I'd ask, has the business changed? Usually, the answer was no. Then why act like it has? If McDonald's stock drops, but they're still selling millions of burgers, what exactly are you reacting to? Price doesn't tell you the business is broken. It just tells you someone else is more emotional today than you are. The best investors I've met have one superpower: they don't flinch. They can watch their portfolio drop 30% and still sleep. Not because they're brave, but because they understand what they own. It's like turbulence on a plane. If you know the pilot's competent, you don't jump out at 10,000 feet just because the cabin shakes. But most investors are standing by the emergency exit, parachute in hand, the second the seatbelt sign lights up. Here's what I call the button problem. Every few years, Wall Street gives people a new button to push. Day trading apps, options, leverage, crypto. Each one promises more control, faster trades, more power, more information. But more buttons just mean more chances to press the wrong one. I knew investors in the late 1990s who were day trading tech stocks between conference calls. One guy bragged he could make $1,000 before lunch. I asked him, "Can you make it after lunch?" He laughed. 6 months later, he wasn't laughing. The average investor's biggest enemy isn't the Fed or inflation or short sellers. It's themselves sitting in front of a screen, mistaking activity for progress. Doing something feels smart. Doing nothing feels lazy. But in investing, the roles are reversed. Activity is often ignorance in motion. Let me give you a simple rule. I used to teach young analysts, if you've done your homework and the company's still solid, don't just do something, stand there. That line usually got a laugh, but it's deadly serious. Because patience isn't passive. It's active discipline. You have to fight every instinct screaming at you to fix something that isn't broken. When you stop chasing control, you start gaining clarity. You stop watching prices and start watching progress. You stop reacting to markets and start understanding businesses. That's when investing stops feeling like a casino and starts feeling like ownership. Because control isn't about pressing buttons. It's about knowing when not to. In the market, motion is the enemy of money. The more you touch your portfolio, the more it touches you back. You'd think the pros would know better. After all, they wear suits, run spreadsheets, and use words like arbitrage before breakfast. But I've met fund managers who behave no differently than a guy at a horse track with a system. They call it smart money. But when fear hits, it's just fast money running for the exits faster than everyone else. During the crash of 1987, the phones at Fidelity were ringing off the hook. The Dow dropped over 20% in a single day, the biggest one-day drop in history. Investors were desperate. Sell everything. Go to cash. Some even said, get out before it goes to zero. Zero? America doesn't go to zero. Maybe some of your judgment does, but not the country. I remember sitting in the office thinking, did Coca-Cola stop selling soda? Did McDonald's stop flipping burgers? No. But you wouldn't know it from the panic in people's voices. Here's what made that day wild. Nothing fundamental happened. No nuclear war, no plague, no alien invasion, just people scaring other people. It was pure psychology. The so-called smart money hedge funds, institutions, brokers, all selling to each other, trying to beat one another out the door. It was musical chairs with billion-dollar portfolios. A few months later, the market recovered most of its losses. But many investors didn't, because they sold at the bottom, then waited for the right time to get back in. The right time never feels right. It feels scary, awkward, and wrong, which is why it usually is right. That's how you separate investors from speculators. Investors focus on companies, speculators focus on feelings. When I talked to my team after the crash, I said, we just got a 20% off sale on hundreds of great businesses. If you're a shopper, you'd call that a bargain. But on Wall Street, they call it a crisis. That's the irony. People love sales until it's on stocks they already own. The real smart money isn't the one with the fastest trade. It's the one with the slowest trigger. When fear spreads, everyone wants to do something. But the ones who quietly sit on their hands, those are the real professionals. Because they understand the simplest math in investing. Panic multiplies losses. Patience multiplies returns. Let me tell you about one of my favorite smart money stories. In 1983, everyone thought the auto industry was dead. Imports were crushing Detroit. Gas prices were high. The future looked electric, literally. But I drove around and noticed something strange. Subaru dealerships were packed. So I checked the numbers. The company was actually growing earnings, while its competitors were bleeding cash. Yet the stock traded for peanuts, the market had lumped them all together. We bought Subaru. It went up several-fold. The smart money missed it because they didn't look. They were too busy managing volatility to notice value. That's what happens when you treat the market like a scoreboard. You miss the game. Every investor says they want to beat the market. But the only way to do that is to ignore it long enough to let your companies perform. If you watch the scoreboard every minute, you'll start thinking you're losing even when you're winning. I've always said investing's like baseball, except you don't have to swing. The market throws you pitches all day. Some are garbage, some are fastballs down the middle. You can stand there all year waiting for your pitch, and no umpire will call you out. But gamblers can't stand waiting. They swing at everything and strike out on the ones they never understood in the first place. So the next time someone tells you the smart money is selling, just smile. That usually means the scared money is buying protection from the wrong thing. They're hedging against volatility instead of stupidity. And there's no hedge for stupidity except patience. The market rewards the patient, not the brilliant, because patience is rarer than genius on Wall Street. One of the strangest things about the market is how entertaining losing money can be. People swear they hate losses, yet they keep chasing them like bad romances. Every gambler has the same line, I almost won. Every investor version of that, it almost came back. That word almost has bankrupted more people than recessions ever did. I once met a guy who owned a penny stock that dropped 90%. He said, if it gets back to 10, I'll sell. It never did. He kept it so long, it practically sent him a Christmas card. That's not investing, that's nostalgia. It's like waiting for your ex to realize you were the one. They've moved on. So has your money. Most investors don't actually want to be right. They want to feel right. That's why they double down on losers. It's not strategy, it's therapy. They think if they just hold long enough, the universe will admit they were geniuses all along. But the market doesn't care about your redemption arc. It only cares about earnings. At Fidelity, we used to joke that the best investors were the ones who forgot their passwords because they couldn't tinker. They couldn't fix what wasn't broken. And without the constant need to prove themselves right, their portfolios actually grew. The people who check their stocks every day, they aged in dog years. The thrill of being wrong is subtle. You lose money, you feel pain, but deep down you also feel alive. You tell yourself you're learning. You read more, trade more, tweak more. It becomes a loop. The more you chase certainty, the less you have it. The market loves that kind of investor. They provide liquidity, hope, and comic relief. I remember a man who owned a company that made laser discs. Back in the 1980s, he said, "This is the future of movies." He was right for about a year. Then VHS took over, then DVDs, then streaming. Each time he said, "Just wait, it'll come back." By the time it didn't, he'd already missed 3 other revolutions. All because he couldn't admit one simple thing. He was early, but wrong. In the market, being early is just a polite way of saying wrong for a long time. The only cure for that thrill is humility. Not fake humility, the kind where you pretend to be learning. Real humility, the kind that admits, I don't know. That's a hard sentence to say on Wall Street, where everyone's paid to sound certain. But it's the only phrase that saves you money in the long run. When I bought Taco Bell in the 1980s, plenty of analysts said fast food was over. They said Americans were getting health conscious. They said Mexican food was a fad. They were wrong, not because they were dumb, but because they thought they knew. That's the danger, knowing too much about everything except reality. Here's my checklist for staying sane. Estad mit mistakes fast. 2, sell them faster. 3, move on immediately. You don't need to win every hand. You just need to avoid going broke before your good ideas pay off. Because investing isn't about perfection, it's about survival. You can be wrong half the time and still get rich if you keep your losers small and your winners big. That's not genius. That's arithmetic. The truth is you'll always have losing stocks. Everyone does. But the difference between gamblers and investors is what they do after losing. Gamblers chase, investors learn, adjust, and live to fight another day. The goal isn't to never be wrong. It's to be wrong less expensively. In investing, being wrong isn't fatal. Staying wrong is. The hardest part about investing isn't finding good ideas. It's killing bad ones. Everyone loves the stock story, the underdog comeback, the turnaround, the hidden gem. Wall Street sells those better than Hollywood. But here's the problem. Most comebacks never come back. Take Pan Am, once the pride of the skies. By the early 1980s, it was losing money faster than it could serve peanuts. Still, investors hung on, convinced it would return to its glory days. It didn't. It went bankrupt in 1991. The lesson? Nostalgia doesn't pay dividends. Every investor has a version of this story. You buy a stock, it drops, you freeze. You tell yourself, I'll sell when it gets back to even. That's the most expensive sentence in the English language. Because you're no longer investing, you're praying for a miracle. I had a friend who bought Polaroid after it crashed in the early 80s. He said, "Peter, it can't go any lower." Oh, it could, and it did. He held for years, convinced that instant film would make a comeback. Meanwhile, Kodak and Canon were already eating its lunch. He wasn't investing in Polaroid, the company. He was investing in Polaroid, the memory. And memory don't compound. Here's a simple truth. The stock doesn't care what you paid for it. It doesn't know your cost basis, your emotions, or your dreams. It just reflects how the world values the business today. If the company isn't improving, why should the stock? That's why one of my favorite investing habits was writing down the reason I bought something in one sentence. If I couldn't explain it clearly, I probably didn't understand it. And if that reason ever stopped being true, I sold. No debates, no meetings, no prayers. You'd be amazed how many people would rather argue with reality than adjust to it. They'll spend months researching excuses instead of numbers. They'll quote Warren Buffett on patience while sitting on a disaster. Patience only works when the business still does. When I sold my losers, people said, "Peter, don't you believe in conviction?" I said, "I believe in math. If the fundamentals crumble, belief won't rebuild them." I'd rather take a small loss now than wait for the market to confirm what I already know. It's not courage that keeps you holding. It's denial with a nice suit on. The irony is, investors talk about risk tolerance like it's a badge of honor. But the real skill isn't tolerating pain, it's avoiding unnecessary pain. Anyone can hold through a crash. But it takes discipline to admit when you pick the wrong horse before it breaks both legs. There's a saying I used to repeat to myself during bad trades. Would I buy this stock today? If the answer was no, then what was I doing still owning it? That one question saved me from more disasters than any analyst ever did. Because the market doesn't care how you got here, only where you're going. Being wrong isn't exciting, but it's freeing. Once you stop defending mistakes, you start compounding wisdom. The best investors I know aren't the ones with the most wins. They're the ones who learned the most from their losses and paid the least for the lessons. The fastest way to recover from a bad investment is to stop making it. Everybody wants the perfect stock. The one that never falls, grows forever, and makes you look like a genius at dinner parties. Let me save you a few decades. It doesn't exist. Every company, no matter how great, will eventually stumble. Coca-Cola had flat years. McDonald's got mocked for salad. Even Apple lost 40% UNSI. If you're hunting perfection, you're not an investor, you're a dreamer with a brokerage account. In the 1980s, investors swore Polaroid was perfect. They said, everyone takes pictures. Instant photos will never die. Then came digital cameras. Polaroid died instantly. Same thing with Sears. For a century, it was Amazon before Amazon. They had the customers, the brand, the distribution. Then they stopped adapting. The problem wasn't competition. It was complacency. Great companies don't stay great automatically. They have to keep earning it, just like investors have to keep thinking. When I bought Taco Bell, it wasn't perfect. They were struggling with franchise issues, inconsistent menus, and slow stores. But people still lined up for cheap tacos. I didn't need perfection. I just needed progress. That's the secret. You don't make money buying flawless businesses. You make money buying improving ones. A company going from terrible to decent can outperform one going from great to slightly greater because expectations matter more than perfection. Perfection is the enemy of profit. When investors wait for the right moment, the right price, the right setup, they miss the right opportunity. The market doesn't reward hesitation. It rewards reasonable confidence backed by homework. If you demand absolute certainty before you act, you'll spend your life watching others get rich slowly while you analyze the weather report. The biggest returns I ever made came from companies that looked messy. AutoNation, Fania Mai, Dunkin' Donuts, Heinz. None were headline stars. They were just solid, boring businesses with room to get a little better. Wall Street ignored them because they weren't perfect. That's what gave me my edge. Because when everyone's chasing the flawless story, the best bargains hide in the ordinary ones. Perfectionism in investing is just fear in a tuxedo. You don't want to make mistakes, so you disguise indecision as discipline. But waiting for the perfect stock is like waiting for a spouse with zero flaws. You'll die single and broke. Here's a trick that helped me stay sane. When you find a business you like, ask yourself 3 questions. 1, do I understand what they sell? 2, can they make money doing it? 3, will people still need it in 5 years? If you can answer yes to all 3, you've already beaten 90% of investors because you're thinking like an owner, not a gambler. You don't need perfect answers. You need honest ones. I remember when I bought Ford, analysts said the industry was too cyclical. They were right, but they missed the point. Cyclical doesn't mean uninvestable. It just means you have to buy it when everyone else is convinced cars are dead. The perfect stock isn't the one without problems. It's the one with problems that are fixable. People always ask me, Peter, how do you sleep when your stocks fall? Simple, I sleep better knowing I didn't buy them for perfection. I bought them because they made sense. Because I knew what I owned, why I owned it, and what would make me sell. That's not perfection. That's preparation. You don't need a perfect company. You need a good one bought at a sensible price before everyone else realizes it's not so bad. If you want to lose money slowly but feel busy doing it, watch financial news all day. Turn on CNBC and you'll hear a man yelling, breaking news, about something that broke 6 hours ago. Then a chart flashes, an expert talks, and suddenly your coffee feels like a trading signal. That's not information. That's entertainment for anxious people with portfolios. In my day at Fidelity, we didn't have 24-hour financial TV. We had the Wall Street Journal printed on paper once a day. And you know what? It was enough. Now investors drown in data and starve for wisdom. They check their portfolios like social media. Every ping is a dopamine hit. Every red number is a panic attack. They call it staying informed. I call it volatility tourism. When people say, the market's volatile, I ask, compared to what your mood? Because most volatility isn't in the market. It's in people. They see a talking head predict doom and think they're being responsible by reacting. But reacting to noise isn't discipline. It's serenity. I once watched a guy sell a great company because a commentator said it was overvalued. When I asked which commentator, he said, the one with the fancy tie. I said, did you check the balance sheet? He said, no, but he sounded confident. Confidence is not evidence. If it were, we'd all be rich. The best investors learn to filter, not follow. You don't need more opinions. You need better silence. The market will always give you reasons to worry. Interest rates, elections, inflation, recessions, war, trade deficit, weather patterns. If you waited for everything to feel calm, you'd never own anything. There's always something to worry about. That's why you get paid to own stocks, not for certainty, but for enduring discomfort. I once said, the real key to making money in stocks is not to get scared out of them. And people laughed, but it's true. The people who got scared out of stocks in 1974 missed the rebound. The people who got scared out in 2009 missed a decade-long boom. Fear always sounds smart. Calm always sound naive. But over time, calm makes you rich. Here's a story. During the 2008 crisis, I got a call from a nervous friend. He said, Peter, the headlines say it's the end of capitalism. I said, if that's true, your cash won't help either. A week later, the headlines changed. Same network, same anchors. Now they were saying, is this the buying opportunity of a lifetime? That's how fast the noise changes from panic to optimism, all before lunch. If you let that guide your investing, you'll never build wealth. You'll just build whiplash. When you filter the noise, you realize something simple. Good companies don't check the news before opening their doors. They just sell products, pay workers, and earn money. Stocks follow that over time, not the shouting in between. I tell people, if watching the market makes you nervous, stop watching. If reading forecasts makes you twitchy, stop reading. You won't miss anything important, because important things show up in earnings, not in headlines. You don't need to outsmart the noise. You just need to outlast it. The market runs on earnings, the noise runs on fear. Know which one you're listening to. Everyone wants to be a long-term investor until the market drops 30%. Then suddenly they're reassessing their strategy. That's investor speak for I'm about to do something stupid. The truth is, the most important organ for investing isn't the brain. It's the stomach. Because at some point, the market will test your guts. Not once, not twice, but over and over again. It doesn't matter how smart you are. If you can't handle watching your stocks fall without fainting, intelligence won't save you. In 1973 and 74, the market lost almost half its value. It was ugly. People were convinced the economy was doomed, that inflation would eat everything. I watched investors dump great companies for pennies because they couldn't take it anymore. But here's the kicker, the businesses themselves didn't vanish. They still had customers, assets, employees. The stock prices just forgot that for a while. A few years later, those same companies tripled. The investors who held on made fortunes. The ones who sold made excuses. Everybody loves compounding until they meet volatility. Compounding sounds peaceful. It's not. It's long stretches of boredom interrupted by short moments of terror. The test isn't whether you can find good companies. It's whether you can hold them when they look bad. I remember buying Chrysler when people said it was finished. They called it a speculative gamble. What they didn't see was Lee Iacocca, the new CEO, cutting costs, revamping the lineup, and launching the minivan, which became a smash hit. The stock went up more than tenfold. but you had to hold it through chaos to get there. It's easy to say you'd have done that. Harder when every headline screams bankruptcy. Here's the real stomach test. When your portfolio drops to gain percent, can you still sleep? When everyone's panicking, can you still think clearly? When you've done your homework, can you sit still while others run? If not, the problem isn't your stocks. It's your temperament. When I gave talks, people asked, Peter, what's the secret to beating the market? I said, time and stomach acid. You can't have one without the other. Every great stock will test your conviction before it rewards it. Every multi-bagger will scare you out, at least once. That's the market's version of hazing it. Weeds out the tourists from the owners. One of my favorite examples was Dunkin' Donuts. I bought it when nobody cared about coffee. Then interest rates spiked, the economy slowed, and the stock dropped 40%. People asked if I was worried. I said, no, people still need coffee and donuts, especially now. That logic worked out just fine. The key isn't pretending to be fearless. It's preparing to be tested, because the market's job is to shake you off your winners. Your job is to hold your seat. It's like riding a roller coaster. The only people who get hurt are the ones who try to jump off halfway. So before you buy any stock, ask yourself, if this thing drops 50%, will I panic or buy more? If the answer is panic, you're not investing, you're flirting. Find companies you can own through fear, not just until fear. That's what separates investors from tourists. In the stock market, your stomach makes more money than your brain if you can keep it from turning. Most investors don't fail because they pick the wrong stocks. They fail because they can't sit still with the right ones. Doing nothing is the hardest skill in investing and the most profitable. People think activity equals intelligence. They say, I'm rebalancing, I'm managing risk, I'm being proactive. What they're really doing is interrupting compounding. Compounding is like planting trees. You don't dig them up every few weeks to see how the roots are doing. But investors do that every day. They dig up their portfolios and wonder why nothing's growing. When I managed Magellan, one of the biggest surprises wasn't how much I bought, it was how little I sold. The best decisions were often the ones that required no action at all. I bought companies like Taco Bell, Dunkin' Donuts, and Subaru, then left them alone. Not because I was lazy, but because they were working. The fundamentals were improving, the earnings were rising, and my job was to not get in the way. You don't need a new idea every week. You need a few good ones that you let mature. But that's hard for most people. Sitting still feels like negligence. Action feels productive. We're wired to equate effort with reward, which works fine in a gym, but terribly in the market. In investing, constant effort often means constant error. A friend once told me he checks his portfolio 3 times a day. I said, you'd make more money checking it 3 times a year. He laughed. Then he didn't laugh when I showed him his trading costs. Every buy and sell eats away at returns like termites in wood. A few points here, a few points there before long, your long-term returns are short-term donations. The market's a test of patience, not prediction. And the easiest way to fail that test is to act like you need to know everything. You don't. You just need to know what you own and why you own it. Then wait. That word wait is the hardest 4 letters on Wall Street. Here's the irony. The less you do, the more the market rewards you. I used to tell investors, in the stock market, the trick is not to outsmart everyone, it's to outsit them. Most people can't do that. They need noise, motion, stimulation. They'd rather make a move and be wrong than stay still and be right later. But time only rewards the still. If you'd bought a $10,000 basket of the S&P 500 inches 1978 and just held it, not traded, not timed, not tinkered by 2020, you'd have over $700,000. No gains required. Just the ability to sit on your hands for 40 years. Yet most investors don't. They jump in and out, chasing headlines, missing the best recovery days, sabotaging their own results. They call it risk management. I call it return management downward. There's a story about a brokerage firm that studied which clients had the best performance. Turns out the top group was people who had forgotten their accounts existed. That's right, the best investors were the ones who literally did nothing, because they weren't tempted by emotion, prediction, or cable news. They let time do the work. You can't build wealth by micromanaging it. You build it by trusting the process, staying calm, and keeping your hands off the keyboard. If that sounds boring, good. Boring works. Exciting costs money. The market will pay you handsomely for mastering one skill, patience. More money has been lost by investors trying to act smart than by those willing to look stupid and sit still. Everyone talks about market risk, but the market isn't your biggest enemy. You are. It's not inflation, or the Fed, or interest rates that ruin portfolios. It's impatience, ego, and fear, all sitting quietly behind your login screen. I've watched brilliant analysts lose fortunes because they couldn't admit a mistake. And I've seen ordinary folks get rich because they just stayed out of their own way. You don't need a PhD to invest well. You just need to stop self-sabotaging. The first way investors lose money is overconfidence. They mistake luck for skill. A few good picks, a few quick wins, and suddenly they're Warren Buffett with a smartphone. Then they start chasing every idea, every tip, every shiny object. They're not investing anymore. They're collecting tickers. The market loves people like that. It feeds them false hope right before reminding them who's boss. The second killer is fear. Fear makes people sell at bottoms, hold cash too long, and celebrate safety while missing opportunity. During the 1987 crash, fear was contagious. People thought the world was ending. But 2 years later, the market had recovered. The fear didn't. If you're scared out of good companies every few years, the market doesn't need to beat you, you'll do it yourself. Then there's envy, the quiet killer. You buy a great business, it doubles. Then your neighbor buys a stock that triples, and suddenly your win feels like a loss. That's the disease of comparison, and it's fatal to patience, because once envy enters the room, logic leaves. You stop managing your money and start managing your feelings. Every investor eventually faces this mirror. You can't control the market, but you can control your reactions. If you chase highs, you'll find lows. If you flee lows, you'll miss highs. Either way, the problem isn't out there, it's in here. I remember talking to a group of new investors in the early 80s. They asked, "What's the most dangerous thing in the market right now?" I said, "You." They laughed. But a few years later, during the next crash, they stopped laughing. Some had sold everything at the bottom. Some bought junk because it looked cheap. Some froze completely. All of it came from emotion, not economics. You can't eliminate emotion, but you can contain it. That's what a written plan is for. It's not to impress anyone. It's to protect you from yourself when you're scared, greedy, or restless. If you don't know why you own something, you won't know when to sell it. And when fear hits, you'll invent reasons, bad ones. I've seen more fortunes destroyed by boredom than by bear markets. Because boredom whispers, do something. And doing something is how gamblers stay broke. If you need excitement, go skydiving. Investing is for growing money, not adrenaline levels. Your job isn't to outsmart everyone else. It's to outbehave them, because behavior compounds just like capital. Discipline today means opportunity tomorrow. The market will always reward those who stay rational longer than others can stay emotional. The greatest risk in the market isn't losing money, it's losing your mind when everyone else does. After 40 years of watching investors come and go, I've learned this. Most people lose not because the market fooled them, but because they never understood what game they were playing. They thought it was about timing, prediction, and excitement. It's not. It's about patience, logic, and restraint. The market is a business game, but most investors play it like a video game. If you're looking for thrill, the market will give you plenty, just not the kind that ends well. But if you treat it like ownership buying, pieces of real companies, solving real problems, the whole thing slows down. And suddenly, it starts making sense. You stop asking, what will the market do next week? And start asking, what will this business look like in 5 years? That one shift from speculator to owner is where wealth begins. When I ran the Magellan Fund, we didn't beat the market because we had secret information or fancy models. We beat it because we stayed sane while others lost their minds. We bought what we understood, ignored what we didn't, and held on through noise, panic, and boredom. That's not brilliance, it's discipline with good timing. But here's the kicker. Anyone can do it. You don't need to work on Wall Street to see opportunity. You just need to pay attention to the world around you. That's how I found Taco Bell, Hanes, Dunkin' Donuts, and Subaru. Not through spreadsheets, through shopping malls and parking lots. Investing is observing, not guessing. You don't need to predict the future, just notice what's already happening that others ignore. People make investing sound mystical. It's not. If you understand 5th grade math and have a 7th grader's patience, you're ahead of most investors. The problem isn't complexity, it's behavior. You can't compound returns if you can't compound calm. That's the real secret. When you think about it, the market's pretty fair. It punishes impatience and rewards endurance. It humbles arrogance and pays humility. It gives everyone the same opportunities and lets human nature sort out the winners. So if you want an edge, don't look for a better algorithm. Look for a better attitude. Investing isn't about beating others, it's about not beating yourself. It's about ignoring the casino in your head long enough to let the businesses you own create value. The market doesn't demand brilliance. It demands consistency. It doesn't require forecasts. It requires endurance. And it doesn't reward gamblers pretending to be investors. It rewards investors patient enough to look boring. The irony of it all, when you stop trying to play the market, that's when you finally start winning at it. Because you realize the market isn't a casino. It's a mirror. And what it reflects over years, not days, is you. Your habits, your temperament, your patience. If you can master those, the market will do the rest. So stop guessing. Start observing. Stop reacting. Start owning. And remember, the goal isn't to look smart, it's to stay invested long enough for common sense to look brilliant. The market's not a casino. It's a classroom, and your tuition is paid in patience.